Somewhere in Washington, the lights stay on long after midnight. Bond yields climb, stock traders hold their breath, and millions of families sleep without knowing the price of money may change again. A central bank is supposed to calm a country, but there are moments when every move it makes sends stress somewhere else. This feels like one of those moments. So stay close if you care about the deeper pattern, because this is the kind of shift that only looks obvious after it has already changed lives. Ray Dalio's warning is not really about one meeting, one speech, or one rate cut. It is about a system that has been stretched so far that even smart people at the top are left choosing between different kinds of damage. That is why the title matters. The Fed may still have options, but the good ones are disappearing. When most people hear the Federal Reserve, it sounds distant, almost abstract, like a building full of economists talking in coded language. But the Fed touches the mortgage on a family home, the rate on a credit card, the return on retirement savings, the value of a pension, and the price of risk across the entire country. If the Fed keeps rates high, borrowing stays painful. If it cuts too soon, prices can rise again. If it prints money to rescue the system, the dollars in your pocket may buy less later. That is the trap Dalio is pointing at, a trap built over years of cheap money, rising debt, political promises, aging populations, and a financial world trained to expect rescue whenever pain gets too sharp. For a long time, the United States could smooth problems by lowering interest rates. Interest rates are the cost of borrowing money. When that cost falls, people spend more, companies expand, and markets usually celebrate. But a country cannot live forever on emergency settings. For years after the financial crisis, rates stayed unusually low. Then came the pandemic, when trillions of dollars were pushed into the economy to stop a collapse. That flood of money helped save incomes and prevent a depression. It also left behind something heavy, more debt, more dependence, and an economy that got used to money being almost free. Now picture the Fed sitting in the middle of three fires. One fire is inflation. Inflation means the general level of prices rises, so each dollar buys less than before. Another fire is growth slowing down. A slowing economy means weaker hiring, weaker spending, weaker profits, and more fragile households. The third fire is the debt mountain itself, which gets more expensive every time rates stay high. Raise rates and the Fed can cool inflation. But higher rates squeeze home buyers, punish businesses that depend on borrowing, and make government interest costs swell. Cut rates and the Fed can ease pressure on markets and jobs. But easier money can reignite inflation and tell the world that price stability matters less than short-term relief. Print liquidity and panic can calm for a while. But liquidity is often just a softer word for making future money worth a little less. That last part matters more than most people realize. The Fed does not have to literally run a printing press to create easier financial conditions. It can buy assets, open emergency lending facilities, and flood the system with support when something starts to break. Markets usually love that at first, but every rescue teaches the system a lesson. Take enough risk, use enough debt, and someone may catch you when you fall. If you've been watching the headlines and feeling like every Fed move fixes one problem while waking up another, you're seeing the same pressure Dalio is talking about. And if that pattern already feels familiar, ask yourself this. What happens when the institution meant to stabilize the system becomes one of the system's biggest sources of tension? That question hangs over everything now. It hangs over your savings, your rent, your retirement, and the price of trust itself. Think about a couple in their early 40s. They did what they were told. They worked, saved, avoided crazy risks, and waited for the right time to buy a larger home. Then mortgage rates jumped. A payment that once looked manageable became something else entirely. At the same time, groceries, insurance, utilities, and property taxes moved higher. Nothing in their life suddenly became luxurious. Money just started going less far, even while they were trying to be responsible. Now think about a retiree who spent decades building a nest egg. For years, low interest rates punished conservative savers. Then rates finally rose, which should have helped. But by that point, the prices of daily life had already climbed. Healthcare cost more. Car repairs cost more. Basic food felt different at the checkout line. So even when savings accounts paid a little again, the retiree was trying to catch a train that had already left the station. This is why the problem is bigger than Wall Street. America now carries federal debt that has climbed well past levels that once seemed unthinkable. When rates rise, the government pays more to service that debt. Debt service means the interest bill on what has already been borrowed. That bill does not build a bridge, cure a disease, or train a worker. It is simply the price of the past arriving in the present. And the larger it gets, the fewer easy choices remain. That pressure spills into the bond market. A bond is basically an IOU. When investors buy government bonds, they are lending money to the government in exchange for interest. If investors become less willing to lend at low rates, yields rise. Yields are the return investors demand. Higher yields are not just numbers on a screen. They flow through mortgages, car loans, business financing, commercial real estate, and the government's own budget. This is where the story gets especially uncomfortable. The Fed can influence short-term rates directly, but long-term rates are shaped by the bond market, inflation expectations, debt supply, and trust. And trust is harder to control than a press conference. If the market starts to believe inflation will stay sticky, or government borrowing will stay huge, or future money will be worth less, then long rates can remain stubborn even when the Fed wants relief. That means the Fed may cut and still not get the easy conditions it hopes for. A lot of people still assume inflation is a temporary fever that will pass and leave everything as it was before. But inflation often leaves scars. Even when the inflation rate slows, prices usually do not go back down. They just rise more slowly. That is a brutal difference for working families. If your paycheck rose 5%, but your cost of living jumped 20% over a few years, you did not move forward. You just learned how expensive stability can become. The hard truth is that financial markets were built around a very different era. For a long stretch, falling rates boosted asset prices. Stocks benefited, housing benefited, private equity benefited. Even shaky business models could survive if money stayed cheap enough. That era trained investors, executives, and governments to think in a certain way. If stress appears, rates fall. If markets wobble, support comes. If debt grows too large, time and low funding costs will make it manageable. But time changed the shape of the problem. Now the same medicine can cause side effects strong enough to rival the illness. Cut too hard and inflation can revive. Stay tight too long and something leveraged can snap. Maybe a bank, maybe commercial real estate, maybe a part of the Treasury market itself. When Dalio says the Fed is running out of good options, he is pointing at that narrowing corridor where every door opens into another room full of smoke. If you want these kinds of pressure points mapped out in plain language, keep following along, because the biggest risks in finance usually arrive disguised as ordinary policy debates. And here's a question worth sitting with. How much of your financial life still depends on the idea that the Fed can always fix whatever breaks next? That belief has carried markets for years, but beliefs are strongest right before they are tested. A fair objection comes up here. People say, hasn't America always found a way through? Didn't we survive inflation in the 70s, crashes in the 80s, the tech bust, the housing collapse, the pandemic, and every recession warning since? Yes, and that matters. The United States still has enormous strengths. It has deep capital markets, world-leading companies, a reserve currency, strong military power, huge natural advantages, and an unmatched ability to attract talent and capital when fear rises. So the issue is not that the system vanishes tomorrow. The issue is that the quality of the available choices keeps getting worse. Imagine a doctor treating a patient with 3 illnesses, where the medicine for one problem worsens the other 2. The doctor still has tools, but the confidence that one treatment cleanly solves the situation is gone. That is closer to where the Fed stands now, not powerless, but constrained, not blind, but operating in a room where every switch controls more than one machine. Now, widen the lens. This is not just about inflation and rates. It is about a long debt cycle. A debt cycle happens when borrowing grows for years faster than the income needed to support it. At first, it feels productive, then it feels normal, then it becomes necessary, and finally, it becomes unstable because too much of the system depends on credit expanding without interruption. That is when central banks stop looking like traffic controllers and start looking like emergency crews. At the same time, the world around the dollar is changing. The dollar is still dominant, but dominance is not the same thing as invincibility. Other nations are thinking more openly about reserve diversification. Central banks have been buying gold at a strong pace. Trade relationships are becoming more political. Sanctions, wars, supply chain shifts, and strategic rivalry are changing how countries think about dependence. When trust fragments globally, the value of financial flexibility rises and the cost of policy mistakes rises with it. Gold matters in this conversation for a reason. Gold does not produce cash flow. It does not invent products or build factories, but gold has one old advantage. It does not depend on someone else keeping a promise. When central banks, investors, and ordinary savers grow uneasy about debt, currency dilution, or policy credibility, gold starts looking less like a relic and more like insurance. That does not mean every spike in gold predicts disaster. It means trust has a price, and that price becomes visible when confidence gets thinner. There is another force here that gets less attention than it should. The United States is trying to manage inflation, defend economic growth, support massive public borrowing, maintain financial stability, fund strategic competition abroad, and preserve confidence in the dollar, all at the same time. Each goal is understandable. Together, they are exhausting because every one of them competes for the same oxygen: capital, credibility, and time. And time is exactly what debt-heavy systems always seem to run short on near the end of easy eras. So where could this lead? One path is the slow grind. Rates stay higher for longer than markets want. Inflation cools, but not enough to feel comforting. Growth weakens, but not enough to trigger a full emergency response. In that world, households keep feeling squeezed. Companies cut costs carefully. Government interest costs keep climbing. Asset prices stop feeling effortless. Nobody gets the clean relief they hope for, and frustration hardens into fatigue. A second path is recession followed by rapid easing. Something breaks. Unemployment rises fast enough to force the Fed into cutting rates aggressively. Markets may even rally at first because easy money tends to lift asset prices, but the relief could come with a hidden leak. If the response is too large or deficits keep swelling, the long-term value of money may erode further. That means stocks could bounce while purchasing power quietly bleeds. People may feel richer on paper and poorer at the store. A third path is the most chaotic one. Not a classic recession first, but a financial accident. A funding market freezes. A large institution stumbles. Treasury market liquidity becomes strained. Credit spreads jump. Credit spread is the extra interest risky borrowers must pay above safer ones. When that spread widens suddenly, fear is spreading through the plumbing. In that kind of episode, the Fed may step in fast, not because inflation is solved, but because markets are too important to let seize up. If this kind of analysis helps you stay calm when the headlines get noisy, stay with me here because the next few years may reward people who can separate short-term relief from long-term stability. And ask yourself something simple. If rates fall, will your life truly get easier, or will the same old pressure just return in a different costume? That is the question many investors still avoid. But households do not have the luxury of avoiding it. The signals to watch are not mysterious. Watch the bond market more than the slogans. Watch whether long-term yields stay high even when the Fed turns softer. Watch credit card delinquencies, small business stress, layoffs in interest-sensitive sectors, and commercial real estate refinancing pressure. Watch whether deficits remain huge even in a non-crisis environment. And watch gold, not as a magic answer, but as a thermometer for trust when policy feels cornered. For ordinary people, preparation begins with a change in mindset. Stop assuming the next few years will look like the decade before the pandemic. That world was unusual. Cheap money covered many mistakes. It allowed weak businesses to survive, debt to pile up quietly, and asset prices to run ahead of income. A more unstable rate environment demands a different style of thinking. Less fantasy, less dependence on perfect timing, more respect for cash flow, liquidity, and resilience. That can mean simple things. Avoid debt that only works if rates fall soon. Keep an emergency reserve that is actually liquid. If you own assets, know why you own them. If you are close to retirement, think carefully about sequence risk. Sequence risk means bad market years arriving early in retirement when withdrawals can do the most damage. If you are younger, focus on your earning power as much as your portfolio. In turbulent cycles, a stable skill set can matter more than a clever trade. It may also mean accepting that diversification has to change. In a world where both stocks and bonds can struggle at the same time, old formulas may feel less reliable. That does not mean panic and buy random things. It means understand your exposures, understand whether your plan assumes low inflation, falling rates, steady growth, and endless policy support. Because if your plan only works in the most comfortable version of the future, then it is not really a plan. It is a hope disguised as strategy. And there is a deeper emotional adjustment too. Many people still think of the Fed as a kind of financial parent. Strict when needed, generous in emergencies, ultimately in control. But systems mature, and so do risks. There comes a stage when no authority can spare everyone from pain. All it can do is move pain through time, redistribute it across groups, or hide it inside the currency itself. That realization can feel harsh, yet it can also make you clearer, calmer, and harder to fool. If you want one habit that may matter more than prediction, it is this: pay attention to incentives. Governments with too much debt are tempted by inflation. Markets addicted to cheap money beg for easing. Politicians prefer short-term relief over long-term discipline. Voters often do too. Once you see those incentives, many policy choices stop feeling confusing. They start feeling human. And human systems do not break because nobody saw the math. They break because nobody wanted the medicine. That is why Dalio's warning carries weight. He has watched debt cycles, currency shifts, and policy responses long enough to know that the final stage rarely looks clean. It usually looks mixed. Strong headlines beside weak foundations. Market rallies beside household anxiety. Official optimism beside quiet asset accumulation by people who no longer fully trust the script. The Fed is not facing one enemy. It is facing inflation, debt, politics, market dependence, and the fading comfort of old solutions all at once. So no, this is not a call to panic. It is a call to grow up financially. The era of obvious rescue may be ending. The era of trade-offs is already here. And when a central bank runs out of good options, the burden slowly shifts back where it always lands in the end, onto families, savers, workers, retirees, and anyone trying to protect the value of a lifetime of effort. If this channel helps you think a little more clearly in a world that keeps getting louder, stay near it, because the biggest financial turning points rarely announce themselves with one dramatic crash. More often, they arrive as a series of compromises. A small cut here, a rescue there, a price increase nobody fully reverses, a debt bill nobody wants to discuss. And one day people realize the system did not break all at once. It just stopped offering easy exits. The Fed may still move markets, calm panics, and delay pain. It may still buy time, but buying time is not the same as solving the problem. Eventually, the bill for years of cheap money, rising promises, and deferred discipline comes due in some form, sometimes through inflation, sometimes through stagnation, sometimes through weaker trust, usually through a combination that leaves everyone arguing about which wound hurts most. And that may be the clearest way to hear Dalio's warning. not as a prediction of immediate collapse, not as a dramatic headline meant to scare you, but as a sober recognition that the system has reached a stage where every fix has a shadow, every rescue costs something, every delay reshapes the next crisis, and the smartest people in the room are no longer choosing between good and bad. They are choosing between bad and worse. When good options disappear, history does not ask who felt comfortable. It asks who was paying attention.